Today, RBA says banks should rely more on private markets for liquidity ahead. Hello again, it's Martin North from Digital Finance Analytics, World latest post covering finance and property news. At the boring heart of banking is an essential requirement, which is access to liquidity. To function, private banks need to manage their fund flows for payment settlements, lending, and to meet regulatory requirements. And at the heart of this financial plumbing in Australia is the way banks interact with the market operations of the Reserve Bank. And today, we got an update on potentially important changes from the Reserve Bank, as Assistant Governor Chris Kent said Australia's central bank will increase the price of all new open market operation repos and introduce a new 7-day tenor at its weekly auctions as it transitions to what it's called an ample reserve system for liquidity management. Actually, Kent last year flagged the RBA's plans to shift to an ample reserves framework to ensure sufficient liquidity is available to keep the financial system running smoothly as billions of dollars of bonds it bought through the pandemic fell due. And he reiterated that the changes will have no implications for the RBA's monetary policy stance. And of course, on Tuesday, the central bank left its cash rate at 4.1% and steered clear of providing guidance for its next policy meeting, which is in May. In a joint statement by the RBA and APRA, they both said that they consider the use of the overnight standing facility by banks to be consistent with routine liquidity management activities, and both agencies are comfortable with the banks using the facility as needed. The RBA and APRA will liaise with banks to ensure that they understand the role of the overnight standing facility and are ready to use it and are comfortable so doing in their liquidity management practices. Now, these facilities will play an important role to supplying reserves needed to keep the cash rate close to its target. And as the system transitions to and in time reaches an ample level of reserves, some market participants may experience potential periods when their demand for liquidity rises, and this could require them to borrow reserves in private money markets from other counterparties that have a surplus relative to their needs. If market participants cannot find liquidity on suitable terms in private markets via the weekly open market operations, they are expected and encouraged to use the overnight standing facility, and doing so will support the implementation of monetary policy under the ample reserve system. Now, today, I want to dig into what this means in practice because, to my mind, it does signal a move by the RBA to drive banks to use the private markets more for their liquidity, with the RBA remaining as a backstop if needed, whereas in recent years the RBA itself had become a more major player in the system, which, as we will see, has caused a headache for the bank and a significant loss to the government. Now, it's worth reflecting that the financial plumbing should be boring, a bit like sewers really, in that when they work, everything is fine, but when there is a crisis, just like a major flood in the sewer system, it can lead to a major stink. In the case of the financial system, a problem could lead to payments unable to be made, cash that can't be accessed, and it could lead to panic, perhaps even leading to a bank run. Back in 2020, when the pandemic was spreading fear and panic, the Reserve Bank chose to open the spigots and allow the banks to access as much cash as they needed. It did this in several ways, including holding daily auctions in which banks could pledge securities to borrow cash, allowing them to take out ultra-cheap 3-year loans at a cost of just 0.1 percentage points, and later agreeing to buy their government bonds via quantitative easing. The net effect of this was that the banks built up enormous $100 billion balances on their deposit accounts at the Reserve Bank, which in turn expanded its balance sheet of assets, such as its holdings of Commonwealth and state government bonds. In fact, the central bank's balance sheet peaked at around $465 billion, with the Term Funding Facility, or the TFF, a significant feature of the strategy, where the banks could access cheap 3-year funds from the RBA, funds which, by the way, it was thought at the time would be lent cheaply to customers, but in fact Much of the funds went back to the RBA, which in turn earned banks interest on them. Actually, as I've highlighted before, not only were taxpayers via the RBA handing profits direct to the banks, but the flood of liquidity was the prime cause of the massive surge in inflation which followed, as can be seen if you look at the money supply charts. In retrospect, the RBA did too much, created a headache for itself in terms of its inflating balance sheet, and the bonds they bought also created that loss. Since then, the RBA has lifted rates significantly and the banks have repaid the TFF, so the bank's balance sheet is reducing as the loans are being repaid and replaced by the banks with other forms of financing, such as borrowing from their peers or selling bonds to institutional investors in the capital markets. The RBA's balance sheet shrank by about 45% in the year to June 2024. That's according to its annual report, but the central bank recorded its fourth straight year of accounting losses in 2024 as the legacy of its pandemic interventions lingered on its balance sheet. The $4.2 billion loss for the year ending June the 30th arose because the interest the bank earned on its portfolio of bonds and other assets, much of it acquired at rock bottom interest rates during the pandemic, is far below the amount it pays its commercial bank depositors. The cumulative losses, which began in 2021, have wiped out the bank's equity, although this does not really affect monetary policy. The bank's negative equity position was $20.4 billion on June the 30th. Now, of course, negative equity does not affect our operations or ability to perform our policy functions, but the Reserve Bank Board considers it important that the RBA's capital be restored over time, Michelle Bullock said in an introduction to the 23-24 annual report. The Treasurer has indicated his continued support for rebuild on capital by retaining future profits. But the big question the Reserve Bank Board has been asking is whether it should let those balances or reserves be run down to very low levels that they were before the crisis, a scarce reserves approach, you could call it, or whether they should maintain those balances at a higher level so there's money in the system when the next crisis starts, an ample reserve approach. Now, while it makes sense for the Reserve Bank to keep ample reserves in the system, it does come with a cost, and this is mainly in the form of interest rate risk, as the central bank is forced to invest those reserves into fixed income assets. So, after mulling its options, the RBA has opted for a middle ground, which is for the system to have low reserves, but for the balances to be ramped up when needed by allowing the banks to pledge assets in exchange for funding at the prevailing cash rate. The crux of the matter is the Reserve Bank prefers the private sector banks to drive the demand and supply of cash in the system free of central bank distortion, though at a price they can still provide support in a crisis. So it seems the Reserve Bank would rather calibrate the amount of cash in the system rather than overwhelm it for years to come. This smaller target approach sounds reasonable at one level. Let the banks who have funds available sell to those banks who need them. Let the private markets do the heavy lifting. But in a peak of irony, this is on the day Trump will announce his tariffs that I discussed yesterday with Damien Klassen. The markets are roiled and risks are being priced back in. So it'll be interesting to see how this plays out as the RBA encourages the banks to tap private markets more aggressively for the liquidity needs and increases the effective price of the RBA backstop. Time will tell if this move, which by the way was well telegraphed, is indeed fit for purpose, or whether to tackle a bloated balance sheet and reported losses, the RBA is effectively moving but not solving the problem of liquidity. Judging by the latest financial aggregates, by the way, to the end of February, it does seem that credit availability remains pretty strong, with housing credit up 5.6% for the year, compared with 4.2% a year ago, and with investor credit growing more strongly than owner-occupied credit, which, by the way, explains the uptick in home prices. And also business credit is stronger too. Broad money remains stronger than inflation at 5.2% growth, which is the same as last year. So all up, we won't really know if the changes the RBA has made will have a real impact. But given how fickle financial markets are, especially in a crisis, this may be tested sooner rather than later if T-Day leads to market turmoil and a liquidity crisis. Timing, as they say, is everything. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.